Hi, everyone. This is Jason Birack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He's Robert Murphy. He's an associate scholar with the Mises Institute and research assistant professor with the Free Market Institute at Texas Tech University. He's put out a number of best-selling Austrian School economics books, including The Politically Incorrect Guide to the Great Depression and the New Deal, The Politically Incorrect Guide to Capitalism, which is one of my favorite books for beginners out there. And he's put out study guides for the more complicated Austrian School books, including Human Action. Robert, thank you for joining me.
Thanks for having me, Jason.
Now, Robert, there's so much going on in terms of intervention in the economies right now. You know, China's tried to stop their stock market from collapsing. The Federal Reserve and U.S. government just keep on doing more interventionist policies. What types of problems are the Keynesians causing both in capital markets and the real economy? And what long-term consequences do you think there could be for all these interventionist policies?
Well, it's a great question. Let me just give you a little bit, and then you can take the conversation the direction you think your listeners would appreciate the most. So right now, I think the issue is with the U.S. is the Federal Reserve has had basically 0% short-term interest rate policy for coming up on 7 years at this point, and they're just finally moving away from that. And so the problem there is that the economy, in my view, became sort of addicted to these low interest rates, and it's a false prosperity that it generates. And so if you look at, for example, it's a good exercise if people haven't seen this before. If you plot the S&P 500 index against the Fed's balance sheet since 2009, they tend to move in lockstep. And then when the few places where the S&P really fell sharply since that point, from 2009 onward, those are all associated with cessations of the Fed's expansionary policy. So when the various rounds of QE ended, you can see that the stock market started tanking, and then they launched another round and so on. And then remember back in August, the markets were roiled. And again, China was involved, and we can talk about that, but also they had been planning on hiking rates for the first time in September of 2015, and then they postponed that because of partly what was going on in the stock market. So I think you see it's a classic Austrian business cycle theory playing out, that they can try to generate this prosperity by having the Fed pump in money, but that's not sustainable. That's not something the market can grow on, and then when they pull it out, you see what happens.
Yeah, and to add to your point there, it seems that, all this money that's printed and the base money supply has just gone nuts the last 10 years. It's gone vertical. This money hasn't gone to Main Street, really. It's gone, to the hedge fund managers and the investment banks, so these guys can make extra money, the guys who already owned assets, so they could buy more assets. And their asset prices have just gone up. And that's something that I guess Ludwig von Mises and Murray Rothbard talked about, how, a lot of the monetary inflation that was created, it would go into the capital markets first. And a lot of people who, bash Austrian School economics, first of all, I think most of the people who bash Austrian School, on Bloomberg or Keynesians, I don't think they've ever read any of it. But they never give Rothbard or von Mises credit for seeing how the monetary inflation would go into the asset prices first, which is exactly what has happened, after 2008 and the reflation, like you said.
Yeah, and a classic example of that discrepancy was in the 1920s. Famous Chicago School economist Irving Fisher sort of infamously predicted in the late 20s that the U.S. had reached a permanent plateau of prosperity, or stock prices had done that, and that things were smooth sailing, and he thought the Fed had been doing a good job because if you look at CPI, that was fairly stable, for long stretches of the 1920s. So if your indicator of whether the Fed was, being neutral or whether it was being expansionary or contractionary was just looking at consumer prices, you would have understandably thought that things were pretty much on an even keel in the second half of the 1920s in the U.S., whereas the Austrians knew that there was a bubble afoot. They didn't know the exact date of a crash, but they knew that central banks around the world had been pumping up markets and that a great crash was coming. So there's an anecdote where Margit von Mises' wife, retells it, saying that he had been offered a position at a very prestigious bank in Germany, I believe, and or maybe it was Austria. I'm getting mixed up as to where he was exactly.
Credit Anstalt,
Yeah,
right?
yeah, exactly. And so then,
I remember reading
and
about
then
that,
he turned it down because he told her a great crash is coming, and I don't want my name associated with it in any way, right? So, it's
you should have started a hedge fund and shorted it.
so just dovetailing with your point, and the Austrians are always sticklers for what is often called Cantillon effects, after the economist Richard Cantillon, who is arguing that when new money comes into the economy, yeah, sure, as a first approximation, we can just treat it as if all prices are rising uniformly in proportion, but in reality, the money enters in a certain place, and then some prices rise more quickly than others, and that's what gives rise to gains and losses. And I think, as elementary as that point is, a lot of people don't see it. So, for example, I've seen people criticizing Ron Paul and others who point out the drop in the purchasing power of the dollar since the Federal Reserve came on the scene, and they'll say, "Oh yeah, but wages rose also, so I mean it's a big wash." Not understanding that, well, no, if you have a printing press, it certainly is to your advantage because you get those new dollars first. And yeah, it's true, if you print up enough money to double the quantity of dollars, and eventually that will work its way around the economy and the prices will generally double, roughly speaking. But that certainly is to your advantage that you're the one that had those dollars first. And so I think a lot of people don't see the importance of that insight.
Yeah, the non-Austrian School people that I talk to, I've interviewed some regular Wall Street people that have made money investing and trading asset classes. They don't count asset price inflation as inflation. So maybe off the record they'll admit that, like in cocktail parties or stuff. But when it comes time to make those bonuses, I think you worked as an economist on Wall Street briefly, so kind of like basically that their goal is to make all these extra commissions and bonuses, and they have to pretend that, oh, it's all my skill that I made this money investing and trading in asset classes, and it wasn't because the Fed basically just threw money everywhere and made almost all the asset classes rise, because that's not like something you could bring to your investors or people or your business partners and tell them that this is why I was successful.
Right. Just to clarify, I was in the financial sector, but I wasn't actually on Wall Street. It was good. I had applied to some Wall Street jobs, but I would have been hired in 2006, and so I would have been on the job for just a few years before everything fell apart. So in retrospect, it was good I didn't get any of those jobs. Yeah, you're right, and it's there's actually some academic work saying that not even just Austrian stuff, but just mainstream economists arguing that from a theoretical perspective, you should include asset prices when you're measuring price inflation. Just for theoretical reasons, because those are, like, for example, if a long-lived asset like a house, if the prices of those go up, well, then, the flow of housing services is getting more expensive and things like that. So there even are some economists dabbling it, but you're right. In terms of everyday and analysts and economists even, they'll say stuff rhetorically like, hey, where's the inflation, guys? Ha ha. And at the same time and say, oh, and the stock market's booming, so you guys were wrong for being fearmongers. So it's like, well, yeah, those particular prices went up. So in fairness, I certainly was guilty, and some others too, of thinking that consumer prices, even narrowly defined to a basket of household consumer goods, I thought that prices for those would rise more quickly than they have. But certainly, it's correct to say that the Fed coming in and pumping in that money boosted a bunch of asset prices.
Yeah, and it's not like those consumer prices, the government data with the CPI and others, it's not like those are going to be honest anyway. If something rises too quickly, they just change the weightings in the basket at the Bureau of Labor Statistics. So they're always looking for ways to make it look like to underreport the amount of inflation, unfortunately.
Yeah, there certainly are all those tricks. And another thing, too, just to understand the context here is, and I think you alluded to it a few minutes ago, it's not as if when the Fed came in and created all this new money that they handed it out via a helicopter drop so that people on Main Street were getting it. In fact, the Fed, I think it was October of 2008, began what was then a new policy of paying interest on reserves. So, in effect, subsidizing commercial banks to not make loans to their own customers, to instead keep their reserves parked at the Fed. And so it's not surprising in that context that all this new money flooding in, and it's not going to, push up the price of bread at the grocery store. What's going to happen, as you say, these hedge fund managers and others get access to all this liquidity. They're going to rush into things like commodities and other types of assets, and you did see a huge bump up in commodity prices and other types of asset prices right when all this new liquidity started flooding the markets.
Now, I want to talk about the Great Depression, 1929, and the New Deal. You have a book out about this, and I just read Murray Rothbard's book out about this, too. I have your book. I haven't gotten to it yet. I just finished Rothbard's book on this. Do you see a lot of similarities coming down the pipe to what happened prior to the 1929 crash and now? Because I see quite a number of similarities where, capitalism is being blamed for problems and the free market's being blamed for problems that are not the free market. And you have these politicians coming in that, I can fix everything, but everyone's taxes are going to have to go higher. And, we have to put in all these new rules and regulations. So do you see a lot of similarities between prior to 1929 and what's coming down the pipe now?
Yes, I would see that. I also, for a while, thought it was even earlier that the housing bubble years were like the 1920s, and then the crash in 08 and 09 was like the 29 crash, and then what we saw since then, where massive expansions in government power, and as you say, as what was now called the Great Recession kept lingering, people just kept saying, "Oh, geez, capitalism isn't working," even though this was a period of unprecedented government intervention. So that's exactly what happened in the 1930s. So there was the 29 stock market crash, and then Herbert Hoover, contrary to what people may have been taught in school, Herbert Hoover did not sit back and do nothing. On the contrary, and he brags about this in his memoirs, he did what was to that point the most intervention, in peacetime at least, of a U.S. president, of executive branch, doing all sorts of programs. It had the Reconstruction Finance Corporation to try to bail out banks, and particularly insidious was that he urged big businesses not to cut nominal wage rates, because Hoover had this theory that what happens when a depression with a small d occurs is there's this downward spiral where businesses cut wages and lay off workers, and so now the public doesn't have enough money in their pockets to spend, so then sales fall, and then it's just, he just thought that was a vicious downward spiral. So Hoover thought, why don't we check that at stage one? If businesses just keep paying their workers the same wages they paid before the crash, then, there's no reason for purchasing power to fall. Well, that was a fallacy, because now as prices are dropping, if wages stay the same, then that means workers are actually getting more expensive even as the economy collapses. So to me, that's the single biggest factor in why was it that unemployment shot up ultimately to 25% and was so persistently high, whereas in previous downturns, the unemployment rate might shoot up, but then it would quickly recover. And that was because wages were much more flexible. For example, the 1920-21 depression, unemployment shot up, but there was actually greater price deflation there in the first 12 months than in any 12-month stretch in the Great Depression, but yet things quickly healed, and we had what was called the Roaring Twenties. So when we're trying to understand why is it that the 1929 crash led to a whole decade of economic misery, which we call the Great Depression, I would say, well, it's because Hoover and then FDR were the most interventionists to that point, and so that shouldn't surprise us. They took us towards central planning, and we had a really awful economy. Why is that so hard to understand?
Well, I think it's just easy for the people in power that have the power now to blame capitalism and the free markets, and a lot of people, don't understand economics, so that's it. The plausible explanation just goes by, and more people, even when it's not the free market's fault, if it's either fascism or cartel or full government intervention, full planning, and Hoover was definitely Keynesian. I mean, he wanted wages and prices higher. He wanted to force them higher. I think he helped put in tariffs and all these other things, but in terms of right now comparing it, I see kind of the U.S. The U.S. markets look like the U.S. markets did prior to the 1929 crash. The rest of the world back then, it was in a depression. Lots of the other economies were in major peril, whether it was England or Japan or Germany, they were in major trouble. And so money flight capital came into the U.S. markets back then and drove up, there was a housing bubble back then in Florida, with swampland being turned into houses like on Miami Beach and things like that. There was a property bubble there too with credit, and then there was a credit bubble too with stocks on margin and things like that. And all this extra capital flew in the United States. And now you have a situation where a lot of extra money is coming to the United States from outside the other countries. It just doesn't make any sense to me how the rest of the world, is in major peril. Their economies, whether it's China or Europe or Japan, they're not doing well. And yet, everyone's like, oh, the U.S. is insulated. It sounds like the same, song and dance from what we heard prior to the 1929 crash here in the U.S.
Well, yeah, I think that's a good analogy you're drawing there. Certainly everything you're saying is true.
And you're right. It's unfortunately, if Austrian business cycle theory is correct, and I think that it is, what the central banks around the world did in response to the crisis in 2008 was the exact wrong thing. That they pumped in a bunch of money, pushed interest rates artificially low, and just kept that policy in force for years. So it didn't allow the needed cleansing process to occur of resources getting reallocated to where they should have been after they were malinvested during the housing bubble years. And so the problem has just festered for several more years. So put it this way, there should have been a pretty painful depression with a small d in 2008, and it would have lasted, if the governments and central banks around the world had just stepped back and let nature take its course, it would have been a pretty awful, let's say, 6 months, but then everything would have hit bottom, and then you would have had sustainable growth from that point on. But instead, they just masked over all those problems by flooding the world with trillions of dollars, denominated in various currencies, worth of money that they just created electronically, and everyone just is now in this limbo thinking, I guess we just magically got out of that huge hole by governments buying a bunch of toxic assets and doing all sorts of other things to rescue the big banks out of the mistakes they had made. And that doesn't make any sense, that all you really did was postpone the day of reckoning. And so, unfortunately, I think that when this new crash occurs, it's going to be a lot worse than what would have happened in the fall of 2008 if the officials in charge had just stepped back and let things play out.
Yeah, I agree. And that's because a lot of people, the people in power, either on Wall Street or in the government, or, the academics who are making big bucks from the Federal Reserve giving them over $100,000 grants, they make a lot of money off the status quo. Why won't Keynesian, and they still stick to these Keynesian theories, even though, according to Keynesian theory, it wasn't possible for there to be stagflation. You have the Phillips curve, which said that high inflation and high unemployment weren't possible at the same time. And the 1970 stagflation should have, killed Keynesian economics, but yet it keeps coming back. Why do you think Keynesian economics won't die, and the government and the people in power, still cling to it and still want to say, Keynes wouldn't have gone for this? When I've read a number of the Austrian School economics books about Keynesian economics, whether it's Murray Rothbard's book or Henry Hazlitt's book or Hunter Lewis's book, and it's just filled with so many flaws, but yet, the government keeps defending it and keeps using it.
Well, that's a great question. I think there's several different things going on. So one is certainly the people in power, they benefit from Keynesian economics because it gives a justification for the policies they want to do anyway. Right, so they're certainly never going to embrace Austrian economics and libertarian political theory, which says, you guys have no role. All you end up doing is making things worse, or you create the very problems in the first place. But in terms of just the average economist who's a Keynesian and what, if he's not directly on the gravy train, what's in it for him? I think the problem is that actual real-world economies are so complicated that if you go into it with a Keynesian worldview, you're going to be able, ex post, to look at the data and come up with a Keynesian story that fits the facts, right? So, Paul Krugman can look at, let's just take what's called the Obama stimulus package, right? Obama he gets elected in November of 2008, comes in January of 2009, does the infamous stimulus package, and unemployment went up higher than they had been warning would happen if they did nothing. Right, remember? So in other words, when it was Romer and Bernstein, I think, were the people whose names were on the cover of this document for Obama's economics team, and they were trying to sell people on this package, this recovery stimulus package, saying, here's what unemployment's going to do if we do nothing. That's why we need this stimulus package to reduce it. And then in reality, with the stimulus, unemployment went higher than they had warned would happen with nothing. So you would think, what more could reality have done to show that they were wrong and that the stimulus package made things worse? But Keynesians were plausibly saying, well, no, the economy was just in worse condition than we realized. You got to compare it to the counterfactual. And so to people like me, that seems like, that's non-falsifiable and they're just being silly. But it's possible. Just, if a patient comes in with a certain illness and the doctor does what is medically considered the right treatment, and the patient gets even sicker, that by itself, that one case doesn't prove that the medicine is really bad. It could just be the patient really was sicker than anyone realized, right? So that's kind of the problem. I guess more generally, you can't have controlled experiments in economics, because really what we would want to do is turn back the clock and then to January of 2009, and not have a huge deficit package put into place, and then see what happens to the unemployment rate and economic growth and so on, and then you'd be able to isolate what was the effect of that stimulus package. But we can't do that in reality, and that's also why we're still arguing to this day over what happened in the 1930s. Certainly my book, as you alluded to, The Politically Incorrect Guide to the Great Depression and the New Deal, I go through and I use the same facts that are available to Keynesians, and in my mind, I tell a pretty plausible, convincing story showing that government intervention caused the stock bubble and crash and then made that Great Depression linger. And yet Paul Krugman to take the same basic facts, and he can tell a story about how awful cutting government spending is when you haven't really recovered. And it's because, again, the things are so complicated, there's so many moving parts. You can always ex post tell a good story, which is why I think Mises and Rothbard are right, saying that economic theory is something you deduce logically, and you sort of arm yourself with that before you go out in the world and start looking at the facts.
FDR's Treasury Secretary, I'm sure Krugman will never bring this up because it would make him look wrong, but FDR's Treasury Secretary even admitted that all the government spending and the debt, it didn't accomplish much of anything. He said it was a total waste of money, basically. But you have this exciting new podcast out with another past guest of ours, Thomas Woods, called Contra Krugman, and you do a podcast, I guess, occasionally every single time that Krugman comes out with a new article. He said some really dumb stuff. Well, if you're an Austrian School economist, it's dumb stuff. But I guess if you read the New York Times every day, you probably agree with everything he says. He calls George Bush a limited government libertarian, and there's so blames capitalism all the time. Some of the stuff in here is just ridiculous that Krugman likes to say.
Yeah, so as you say, people go to the website ContraKrugman.com. They can see the archives. And, yeah, what we do, it's a weekly show. And on a typical week, Krugman has 2 op-eds in the New York Times. And so we typically pick the Monday one and then, address that and critique it. And so usually the podcast gets up by the end of the week. So, there's not much of a lag there. And, yeah, we just go through Krugman's column. And it gives us a good springboard, to note his hypocrisy on certain things and how he's always carrying water for the Democratic Party. But beyond that, it gives us a good opportunity to teach Austrian economics in contrast to his Keynesian nostrums.
I want to talk about inflation and deflation going on right now in the real economy. Keynesians hate deflation. It's kind of like the boogeyman, I guess. But the Austrians believe that deflation is good. So lower wages, lower prices, the economy can do more with less. Consumer gets more purchasing power. It incentivizes people to save. Are we ever going to get back to this, or are things going to have to blow up first? Is everything going to have to totally collapse before people start figuring out that, this Keynesian policy, none of it's going to work. People need to start saving money. People start need to producing more before they consume.
Yeah, good questions. I mean, fortunately, at the household level and average businesses, they all understand that if you've been running up huge debts or if the future all of a sudden becomes bleaker than you had been predicting earlier, that the correct thing to do is to cut unnecessary expenditures, try to boost your income, and just save and invest more. So people still know that at the household level. So the problem is that a lot of people, for some reason, think that, well, I know why. It's because they've been taught this, and they have Nobel Prize-winning economists telling it, twice a week at the New York Times, that those rules don't apply when it comes to the economy as a whole, that there's a fallacy of composition involved. And, just because you're better off if you save more, if we all save more, we'd all be worse off, that kind of argument. And so you're right. I think just intellectually, we just have to do what we can to try to get people to see that that's not the case. And fortunately, I think that does have its limits. And so you saw that with major governments, Western governments, since the financial crisis, that they all engaged in large budget deficits. But after a while, when it wasn't working, reality reasserted itself. And some governments really did either limit the growth of spending or even had outright cuts in spending, which doesn't typically happen. So I think that for good or ill, there is, the political process does try Keynesianism for a while, and then if it doesn't work, they do kind of pull back from the precipice because they realize we can't just keep piling up debt indefinitely. So what would it take for them to really turn around, and ultimately it would take educating the public and getting them to see that there is, there's nothing qualitatively different about the government running up huge debts in your name. That's not the path of prosperity either. Even you can see that in your own household. It's certainly not true if the government does it. But are we going to get out of some big crisis? Unfortunately, I think the central banks and major governments around the world have really dug themselves into a big hole. So if you're just asking me, are we going to be able to get out of this smoothly? I don't think so. I think that there is going to be a crash coming, and maybe even some major governments are going to just default on their debt because they're going to be stuck.
Yeah, I think that's likely too. Or they'll either inflate it away, or maybe they're emerging market and they won't be able to inflate it away as easily. Like it would be easier for the U.S. because it has the world reserve currency right now to inflate it away and just force the other countries to take the dollars because of their military. But a smaller emerging market country doesn't have that luxury because they borrow, from Wall Street and things like that, and they can't borrow as much as they want. That's why you have hyperinflations more in these other countries like Argentina and Brazil and things like that.
Right, and even there, it was for a while it was unclear to me what the U.S. policy was going to be. But since Yellen has come in and they, engage in the so-called taper, the Fed's balance sheet has not expanded for some time now, and so it does look to me like they're saying, okay, we can't just keep every time there's a hiccup in the stock market, launch another $300 billion round of asset purchases. I think they're realizing if we don't want the dollar to crash, we have to pull back on that. So, who knows? They might change their minds if the market falls again really heavily. I don't know what's in their minds or what constraints they're under. But you're right. I think even the people behind the Federal Reserve are recognizing that there's not an infinite capacity for them to just keep issuing dollars. And now that the Chinese currency has been adopted by the IMF as part of the reserve currencies for SDRs, I think this sort of special privilege that the U.S. has had is now much more constrained.
Now, you talked about an economic education. Our podcast, our Wall Street from Main Street podcast, is about teaching people Austrian School economics, learning the basics. What are some of the basic books, some of the best beginners books in the Austrian School that you think every young Austrian School economist should read so they start gaining, a comprehension of the basics before they move on to the more advanced Rothbard and Mises books?
Well, sure. So I actually wrote a textbook called Lessons for the Young Economist. So if people want to Google for that, or if you have a link, and there's a free PDF, and there's also a teacher's manual, so that's ideal for homeschooling parents in particular, but obviously any kid can read it. So I wrote that with like a junior high audience in mind, where it doesn't assume you have any background in economics and just teaching you stuff that it's consistent with the Austrians. I don't call it Austrian, but it's consistent with the Austrian school. I still think Henry Hazlitt's Economics in One Lesson, that everybody needs to read that. There's Gene Callan has a good book called Economics for Real People. That's a bit of an introduction to the Austrian school. But ultimately, I think people, if you really want to know the Austrian school, Murray Rothbard's Man, Economy, and State is sort of a prerequisite to that. Oh, I should also mention my new book, Choice, from the Independent Institute. What I did there was take Mises' Human Action and try to distill it down into like a 300-some page book that would be accessible to an undergraduate audience. So before tackling Human Action, which everybody should do if you're really a fan of the Austrian school, my book Choice is supposed to be sort of an introduction to that it has the language that's not so intimidating, and I have numerical examples to make sure you're getting what Mises' point is in certain sections.
Yeah, I took MBA classes. I didn't take any business classes undergraduate. I have degrees in history and political science, and in my MBA in the library, the business school there, they didn't have any Austrian School economics books. So it was very frustrating for me to figure out how to learn. But I guess now with the internet and after the 2008 crash, it started to wake more people up. But, most people, the average business school person, if they're already out of school or they're in business school or MBA right now, they haven't ever heard of it. And the stuff they do hear, it's bashing articles on CNBC or Bloomberg. Oh, the Austrians are wrong. The gold price isn't higher. Blah, blah, blah. There's not, runaway inflation and all this. But, almost all these articles I read either on Seeking Alpha or wherever that bash the Austrian school, They're not quoting anything where they actually understand it. It just seems, they're scared of it, and they've written this article to get people to not even read one Austrian School economics book.
Well, yeah, and but I wouldn't get too discouraged about that, because I'm old enough to remember there was a point when nobody even knew what Austrian economics was. And when I say nobody, you know what I mean? Like people, so-called normal people in the financial mainstream, they didn't even know what it was. So, ironically, it's we're at the point now where they're ridiculing it. That's actually progress compared to where we were 10 years ago, 15 years ago. Also, I should say for your listeners, if you really understand the Austrian school and to figure out, is this something I want to devote my time to studying, just go to places like Mises.org, and Mises is M-I-S-E-S, or fee.org, F-E-E.org, and just read just their they'll have sort of like commentary on topical issues of the day from an Austrian perspective. And so I think that's one way of seeing how, oh, wait a minute, this really is different from what I'm getting from CNBC and places like that. Because typically the mainstream financial press is Keynesian, whether or not they even realize they are. But just the idea that, oh my gosh, in December we better hope that consumer sentiment and consumer spending is really high, otherwise we're going to have a bad economy. That whole idea that it's spending by consumers that drives things, that's a Keynesian idea. Whereas, as you and I talked about a few minutes ago, in the Austrian tradition, it's saving and investment are really the key underpinning of future economic growth.
Exactly. You got to produce before you can consume, and you got to save, and you should consume then from your savings instead of borrowing debt and debt. But, Keynes, I think, borrowed a lot of this stuff from Marx in terms of that, because Marx talked about, the supply glut and how, if people were producing and in saving, they were hoarding, and that was preventing the proletariat from getting higher wages. And Keynes basically, in the general theory, just basically copied that. So, there's a lot of Marxist ideology mixed in with Keynes, and there's a lot of Marxist ideology, unfortunately, now, embedded in so much of the U.S.'s culture.
Yeah, and I think, ultimately, to understand it, it's people deep down really are fueled by envy, or many of them are, and there is this just hatred of the rich, and so certainly policy proposals that advocate jacking up. You mentioned Contra Krugman, the column that Tom Woods is the co-host of that. Tom and I just talked about earlier today that we put it in the recording. Krugman was saying, isn't it good that Obama got reelected in 2012 because he raised taxes on the rich? And, and he made a passing remark about, because we want to raise revenue and stuff. But it was clear, the real coup, the real achievement was sticking it to the rich people. Because Krugman didn't even mention so much about the revenues and so on. It was just more about, look at this achievement, raising tax rates on the rich and rolling back things back to before the Reagan Revolution. So there definitely is this idea of, and certainly the success of Thomas Piketty's book, that I think a lot of that is just people are very jealous and envious of those who have more income than they do or more wealth, and so they like politicians who promise that we're going to stick it to those people.
Yeah, I think a lot of those guys, really enjoy Marx. Obama actually, in his biography, before he got elected, a lot of people didn't read his biography, but he actually called the private sector the enemy. So, and Piketty, he wants all these governments all around the world to unite, and he wants a global wealth tax, right? So no one can move their money to a safe haven country and things like that, and he just wants a global wealth tax so more money can be confiscated. I think we need lower taxes. I think the private sector, the small businessman, the guy on Main Street, they need to be incentivized to create more jobs. Like these phony job numbers that are out today from Wall Street, they're mostly part-time jobs, and they're not, value-added manufacturing jobs. We're not creating a lot of new goods and services. These are, low-paying service sector part-time jobs, because a lot of the small businessmen now, they don't want to hire full-time. They got all these extra taxes and Obamacare and all these other rules and regulations. So, unfortunately, Robert, I see a lot of the people in power, the status quo, they like what the policies are doing, but the unintended consequences is I think they're going to blow everything up in the near future. My biggest worry is that, they're going to blame capitalism, and the people are not going to understand what's really going on, and they're going to agree to, sky-high taxes like what Bernie Sanders and these other politicians want.
Well, it's funny you say that, because I'm now so cynical. I think they're intended consequences, at least from certain of the people high up, that
these proposals like to raise the minimum wage to $15 an hour and things like that I can't believe, because even the literature that is the so-called revisionist literature saying how, there's modest impacts on employment of teenage workers from, minimum wage hikes and things, those are all for fairly modest increases in the minimum wage. And we could talk about whether those studies are valid or not, but the point is there is no published study saying if you double the minimum wage, which is more what would happen now, we'll raise it from, $7.25 an hour to 15, that's going to have a modest impact on employment. No published results say that. Even I don't know if it was Carter or it was Kruger, but one of the authors of that famous, Card-Kruger study was in the New York Times within like the last 4 or 5 months saying, a modest increase like the 10 an hour will be okay, but geez, I don't know about going up to 15 an hour. Really, our literature doesn't support that, and yet that's what a lot of these people are pushing for. So I think the politicians who are behind that, their economists must be telling them behind the scenes what the situation is. So I think they're okay with creating vast numbers of people who can't find work, because that's how you expand demand for the welfare state. And if you're in power and you want to, expand the welfare state, you want there to be a bunch of people who can't support themselves through the private sector and need you to rescue them.
That's a good point. And these forced higher minimum wages, they're causing unintended consequences, or depending upon which group, then intended consequences. Like you said, in Seattle and LA, we're seeing more switches to automation and robots. So, whereas at some of these larger chain restaurants where there was more servers, now there's touch screens where people can pay and things like, and order from, and less servers are needed when you have that, because you can have one server cover a lot more tables because people can just order and things like that on their own.
Yeah, and just to elaborate a little bit, I had a remark a minute ago about those empirical studies. That's something I'm working at here at Texas Tech with a grad student, and we're going through, because there is this revisionist literature that's purporting to show that, hey, we look empirically and we do regression analysis and correct for all these other factors, and lo and behold, it looks like when the dust settles, modest hikes in the minimum wage really don't have that big of an impact. But part of what they're doing is they're controlling for different regional trends in employment. And I'm concerned, it seems like one of the things, or what could be going on, is that suppose, I'm just making this example, but say one state raises the minimum wage and the adjacent state doesn't, and then all of a sudden employment in the fast food restaurants in the state that raised it goes down relative to the other state. If they then look at it and say, oh, but you know what, for some reason the Burger Kings and McDonald's in this state switched more to automation, so that's what explains it. It's not because of the minimum wage hike, when obviously the one might be causing the other. So it's that kind of stuff that makes me a little bit skeptical of, that might be part of what's going on in these so-called revisionist studies, because just prima facie, the raw data, if you just do a very simple regression, are consistent with the claim that raising the minimum wage, making unskilled workers more expensive, makes employers not as willing to hire them.
Yeah, because normally in the past, Robert, in a free market, at least the way I learned about free market economics, the only way a worker could justify a higher wage was not, through if there was inflation, they would go to their employer and say, oh, my cost of living went up, I have to have a higher salary. They would have to be more productive. They would have to either create a new product or service, or create some more value for their company, or things like, or they would have to be more productive with their time in order to justify a higher wage. And I guess it's maybe because of our entitlement culture and a lot of the brainwashing that's been done with, the mainstream media and in academia and the textbooks and things like that. People just have this entitlement that, oh, my wages should always go up and things like that, even if they're not productive at all, more productive.
Yeah, and there's, I should just acknowledge, there are sophisticated economic models of monopsony power and stuff like that, where you could come up with a way to show, under these circumstances, raising the minimum wage wouldn't lead to blah, blah, blah. But the thing is, even in those examples, my understanding is that there would be telltale, like a signature. Like you would see other things happening in the labor market if that really what was going on, and yet we don't see that signature. And so these empirical studies that purport to show historically, empirically, that minimum wage hikes don't go hand in hand with reduced teenage employment, I don't think anyone, even the people pushing those studies, has really come up with a very convincing explanation as to how can that be? How can it be that when you make labor more expensive, employers don't try to substitute away from it? I think they're just saying, well, that seems to be what the numbers are showing. And as I've said, there's some serious doubts I have about their demonstration.
Yeah, well, from the Austrian School economics perspective, we know that real economics isn't a hard science anyway. So, I mean, yes, behavioral finance is kind of like, in certain instances, it, measures human behavior, but they do science experiments. And there's some good things about behavioral finance, but, Keynesian economics part where they're doing all these statistical formulas, and it's just very confusing and a bunch of gobbledygook for me. I think they mostly just they come up with, a conclusion, and then they look for ways to support it with their data, like either new formulas or weightings or things like that. I think that's what they basically do with the math part and science part of Keynesian.
Right, and I think also it's and people may hear you and say, wow, that guy's really cynical and shit. And the thing is, with economics, I joke and I say, look, as a consultant, if I had no conscience or principles, I could give a client any result the client wanted, and I wouldn't even be lying, right? There are so many things, degrees of freedom, if you will, in building a little economics model that you can make just about anything happen. I mean, and there's, Krugman was touting studies in the depths of the Great Recession that were showing all sorts of counterintuitive things, saying that, raising wages during a period of depressed activity it makes, workers get hired more, and saving, makes the economy crash, and all sorts of, paradoxes, and they could explain it by referencing the liquidity trap. So the point was they weren't lying. I mean, they could build a little model where that was true inside the world of the model, but the point is that, it's because economies are so complex, and once you bring expectations into it, I mean, you can do all kinds of stuff. You can, if they pump in all sorts of money into the financial sector, but the public is really convinced that the Fed's going to suck it right back out once price inflation gets too high, well, then that's consistent. Then all of a sudden the traditional historical connection between the monetary base and CPI breaks down. So you can tell just about any story you want, and that's, again, why I think you're right to say economics it's not like physics or something. It's not like we have all these scientists in white lab coats looking around measuring things when people make forecasts about what's GDP going to be next quarter. It's really nothing at all like that, and that's why I think Mises and Rothbard and people in that tradition are just being more intellectually honest when they say, stop trying to make it look like economics is like physics or chemistry. It isn't. Instead, let's focus on things we can logically deduce from what is called the action axiom, and then we come up with this core body of economic theory that we're sure is correct insofar as it goes. It doesn't let us make quantitative predictions, but it helps us explain the causal forces in an economy, and that at least gives us some guidance, as opposed to fooling ourselves and our fans by thinking we're being very empirical, when really, as you say, I can build you a model that gives any kind of output you want.
Yeah, I think there's a quote, I'm probably going to botch it. I think it's like there's damn lies in statistics, or you can make anything, you can make any conclusion you want with the right statistics and model and things like that. So this is just the world we live in now. There's a lot of, I call it economic propaganda. I actually read this book about Google, and there was a little juicy tidbit in there about one of the co-founders of Google. His name was Sergey Brin, the co-founder of Google, and his father was a Soviet economist. And his father was hired by the Soviet Union government to, hide the amount of inflation, and also to come up with, models showing how the Soviet standard of living was better than the American standard of living. So that's what he spent all of his time doing in the Soviet Union. And, it seems like all the Keynesians, they're doing similar stuff here, but no one wants to talk about that.
Yeah, and it is funny that, earlier in the show you had talked about being skeptical of the official consumer price index and all the questionable thing, judgment calls that the economists at the BLS have to make when they, come up with those reports. And I've heard people castigate such talk as, oh, that's a conspiracy theory. But yet, we all know that, like the Chinese government, that those numbers, you have to treat with a huge pillar of salt and so on. And as you say, everybody knows that the official numbers coming out of the Soviet Union in retrospect were totally garbage. So,
it could be a matter of degree, I suppose, but it's not that we're crazy for thinking that governments, when they release official statistics about their economy, have an incentive to massage the numbers in a way that favors the people in power.
I completely agree, Robert. And the funny thing, when people say, "Oh, you're a conspiracy theorist," I bring up about China, and I ask them questions. I was like, "Where do you think? First, I asked them, do you agree that the Chinese, like almost all their government statistics, GDP, and all those things are manipulated?" And they say yes. And then I asked, "Well, where do you think the Chinese learned it from?" and then some of them, like, they have a blank look, and I say, "Well, they learned it from either Wall Street or American universities or England or London universities." So it's like most of the central bankers, Robert, like whether they're in China or the United States or Japan, they've all basically went to the same like dozen or so Ivy League schools.
Yeah, that's a good point. That's a good way of putting it. Exactly.
Okay, great. Well, I enjoyed this discussion a lot, Robert. I could talk about Austrian School economics for hours, but I think I should let you go. Please tell our listeners more about the Contra Krugman podcast, where our listeners can read all your new articles and where they can buy your books.
Sure. So, again, the website for the podcast is ContraKrugman.com. So, Contra's CONTRA, and then Krugman's KRUGMAN.com, and that's where you'll find the archive of the podcast. And my website is consultingbyrpm.com. And my books are, if you go to my website, you can see a list of them, or just on Amazon, you type in Robert P. Murphy, you'll come up with a list of all my books.
Great. Well, thank you for your time, and hopefully we can come back. You can come back on again soon and talk about Austrian School economics with me.
Sure thing. It was a pleasure, Jason.